Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC, member SIPC. My co-host tonight is Chuck Steege, CFP and CEP of SFG Investment Advisors, Inc., and they are SEC registered. And Adam Newman is our special guest. He's also a CFP, and he's also with SFG Investment Advisors. And as I say, they are SEC registered advisors. So it's going to be a great show. Stick with us. Okay, Chuck, let's get started. First, I want to talk, as people that have seen the show before know, you are pretty good at talking about these different kind of executive plans. And tonight we want to talk a little bit about this one type of plan, which is the stock-based compensation arena, right?
Yeah.
So talk to me about how people can invest in a stock plan and avoid taxes.
Okay. So great. Thank you. I appreciate it. So there's a lot happening in the executive compensation field this year, 2015. There's a huge thrust, and I've talked about this on previous shows, a huge thrust towards post-vesting holding requirements on things like restricted stock units. And this is typically expected of the most senior level corporate executives. It's just generally good corporate governance. There's really a focus on that from the shareholder groups, and proxy advisors are very much focusing on this arena.
So post-vesting, for our viewers and listeners, in other words, there's a period of time when you come to a company where you accumulate the stock and you have to stay at least that long. And once you've reached that, you're post-vesting, correct?
Correct. So once you can legally take possession of the shares, even though you have a legal interest in those shares, you're now, if you're one of the most senior level folks, you're now required to continue to hold those shares for a period of time.
That's called restricted stock?
Restricted stock units.
Okay.
Yeah.
And generally, for people who have restricted stock, what's the period of time before they can sell it after they have vested?
Well, it depends on the plan. Oftentimes these plans will require a 1-year hold post-vest, maybe 2 years, and in some cases as long as retirement. Most of this really applies to corporate insiders.
Mm-hmm. What's an insider?
So that's a great question.
Yeah.
Just about anybody is actually an insider. Somebody who hears from, what's going on within a company, and particularly where they have possession of non-public material information that can allow them to profit. They're considered an insider.
So that could be a secretary who's typing up the information, right?
Most definitely.
Yeah.
You're sitting on a train and you happen to eavesdrop on a cell phone conversation. But also insiders would be financial advisors, stockbrokers, tax folks, legal, anybody who is privy to material non-public information.
And I assume it's the SEC that makes the rules about who is an insider?
Almost definitely. And they really do require quite a bit. They have pretty stringent rules, you can imagine.
Sure. Okay, well, are these tax advantaged investments when an insider or any employee of the firm is given this type of stock? Do they get a tax break on the front end, or do they get a tax break on the back end? How does that work?
Okay, so what I wanted to talk about tonight, and I think you're alluding to, is what are known as 10b5-1 plans.
Right.
And 10b5-1 plans are typically a tool that is used by the most senior level corporate executives, insiders, CEOs, CFOs, the CEO and let's say the 4 top paid folks, directors, executive directors, or board directors. And they are really a tool that protects the executive and also aligns with shareholder interests in that it's a predetermined plan for those individuals to be able to sell their own company's stock.
Okay, and can this type of plan have milestones that have to be hit for a key executive to get so many shares of stock, or is that a separate type of a thing?
That's a separate type of a plan, but you raise a good point when it comes to share ownership, because a lot of companies will require their most senior level folks to have holding requirements. You know, a CEO might have to hold, let's say, 12 times his or her compensation.
Okay.
But the real risk for that senior level exec is having too much accumulated in their company's stock.
Mm-hmm.
What do if they can't then sell the shares? They're really restricted to certain periods of time when they can sell those shares.
A window of, say, 3
Yeah.
months out of a year?
Correct.
That type of thing?
So usually those windows are opened up, and it might be a few days after the earnings announcement that window opens, up to a few days before, let's say, the end of a quarter, where within that period of time that executive is able to sell.
Right.
Now, in the case of a 10b5-1 plan, which is a very powerful tool, those sales could happen during the blackout period, so during the periods where the window to sell aren't typically open. And the reason why they're able to do that is it's a predetermined plan that would have been put in place during a prior open window period, so that when the shares get sold, it might be a few quarters down the road.
I see.
And at that point, a certain number of shares are sold or certain price targets are triggered. And so that's really, a 10b5-1 plan is really intended to make sure that there's good corporate governance.
Now also, I know that I see in the newspapers the list of insider sales, so a corporation is required to let the world know that an insider has sold a certain number of shares at a certain time, correct?
Absolutely. That anytime an insider sells, they have to file what's known as a Form 4, and they have to do that within 2 days. Those transactions are picked up very quickly and must be reported to the investor community.
All right. Well, there's always pluses and minuses to each plan, a 401k or whatever. What are some of the downsides to this plan?
Well, the downside, again, we're focusing on corporate governance, not so much in terms of, it being a plan that's, let's say, complementary to a 401k plan. Okay. The downside might be the perception by shareholders that, gee, a sale goes off, why is that CEO's shares being sold during a blackout period, or when there seems to be a spike in the stock price? Well, it's a lot of this comes down to perception, and a 10b5-1 plan, quite frankly, it's not foolproof. It doesn't provide 100% protection, and most insiders understand this. But it is a good defense, and it's a good argument. You as investors have the ability to look at a company's public records and find out whether the CFO, the CEO, the COO has a 10b5-1 plan in place, in which case that kind of gives you an indication as to the direction that executive views the company going.
And when you talked about people concerned about the insider selling, I remember a cartoon in Barron's once when an executive had sold a huge portion, and it showed two pilots whistling as they walked down the aisle toward the back of the plane with their parachutes on. And that's sort of what I think about when an insider is selling a lot of stock. Mm-hmm. Okay, someone interested in this, how can they research what plans are available? What's best for that particular viewer or listener? How do they find out the best plan to go to their chief financial officer and say, would you please set up this type of plan?
Excellent, thank you. So most senior level executives are still learning, believe it or not, they're still learning about 10b5-1s. If their corporate counsel hasn't already made them aware, the resources would be to get with a qualified person, a legal advisor,
like
a financial advisor. Well, we do advise on 10b5-1s. We don't actually put them in place. It's usually the corporate board that makes that determination, but they can be confusing. Case in point, we're working with a CFO of a public company right now who has very specific questions around how to best deploy his 10b5-1 plan, and that's the sort of thing that we're able to help him out on.
Wonderful.
For investors, I'll make this point real quick. For investors, it's really going to be important for you to look at the company's public records, the 10K, the 10Q, and find out what those senior level executives have in place.
Okay, thank you. Let's try to help one of our viewers. Jeff Jenkins in Newtown Square. What value do you place on leadership when investing in a public company's stock?
Leadership is absolutely key. There are all kinds of theories and viewpoints around disciplines around leadership. We think of guys like Jack Welch. He's one of the most premier leaders. Without good leadership, you don't have employee engagement. And so, if you're looking as an investor at the leadership quality of whoever's at the top, that's paramount to the future success of that company.
Well said. Okay, if you have a question for us, we're going to put on the screen the information you'll need in order to send us a question.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
And now on to our special guest, Adam Newman. Adam, thanks for being here. How you doing?
Very well. Thanks for having me.
Good. Well, let's start out. What do you think about 2015? How's the market outlook look to you?
Well, I think if we use January as a proxy, I think the story's been volatility, and it's interesting to have to say that and point that out as being unusual because we expect markets will go up and they'll go down over time. But the past several years, it's like we've been on a flight. We're flying on a plane, and all of a sudden you hit a little bit of a bump after smooth sailing.
Yeah.
It'll catch you off guard. You expect it, you know what's going to happen, but it's still a little bit unsettling. So January, we saw the Dow Jones 3/4 of the trading days move 100 points up or down.
Of course, 100 points isn't what it used to be, but it still scares people.
Absolutely, it's still movement, and it's still something we haven't seen. So, and it's general themes that have carried through the year. It's a stronger dollar. It's the Federal Reserve. What are they going to do with interest rates and monetary policy? And then lastly, it's the oil prices, falling by 50%. I know there's been talk of it's a net positive, but I think just a general drop in a commodity price by that magnitude, it's going to shock the markets a little bit in the short term.
Yeah, people are nervous, sure.
So why do you think investors are most concerned? You mentioned those three themes. So, if you could expand on that a little bit, it'd be helpful.
Well, I think today, in at least looking at it, using our client base as an example, two topics that have really come up as discussion points has been the rise in interest rates. Number one, look back to 2013. That was the first year intermediate bonds posted negative total returns since 1999. So retirees and those that are saving are getting their statements, and they're looking at their bond holdings and seeing that they've lost money, and they're going, that's supposed to be the safe or fixed part of my portfolio. What's happening? So, given rates have fallen, in the recent, 12, 18 months, there's still that anticipation building up. When is that going to happen again? And when it happens, what's that going to do to my portfolio? Number two, I would just say the current state of the U.S. markets in terms of valuations. We've got a several-year run-up at this point, and people are still remembering in their short-term memory 2008 and what that felt like. They're waiting for that next big drop.
Sure.
Not to say that will or won't happen, but it's still, the anticipation is there, and it's certainly warranted.
I want to remind our viewers and listeners we're not lawyers, we're not accountants. We're giving our opinions on the market. They should also consult their own financial advisors before they make any decisions. So describe what you feel are some of the risks. Let's take viewers and listeners that are approaching retirement or thinking about, gee, I'd like to be able to retire in a few years. What would you say to them?
I would say this. Look at not just retirement as being the long, in many cases, 30, 40-year runway
Sure.
that you have ahead of you, but break it down into the 5 years before retirement and then the 5 years into retirement. And there's two risks that are really going to surround that period of time, that red zone. And that is, number one, funded status risk. That is just investors, typically their failure to sit down and match their current assets with what they anticipate their long-term liabilities to be. They've spent many years saving, and the focus has been on growth, growth, and growth. Mm-hmm. And by the time they get to the point where they need to take distributions, have they factored in the future impact of inflation? Have they factored in their stomach for risk and volatility? And do they know if that asset base is going to be able to, maintain their lifestyle for, like I said, what can be 30, 40 years in some case?
Sure.
Secondly, which is really big, and there's been a lot of great studies that have come out recently around this, is return sequence risk. And that gets into the 5 years after your retirement date as well, and that's the impact that large market movements to the downside have on your future funding ability, if they occur early on, in retirement. So those that retired in 2007, they saw if they were heavy in equities, if they were kind of chasing the returns of the markets, they lost in some cases half of their nest egg.
Yeah.
You're almost better off experiencing those types of losses further down the road than you are right upon retirement. So that absolutely has to be quantified.
Adam, you've mentioned risk a couple times. How, that certainly is a factor. How does one position their portfolio given the risks that do exist?
Well, I think it comes into quantifying risk. Risk can be seen as a questionnaire on a sheet of paper that tells you if you're conservative or aggressive. But I think risk is a function of two inputs. There's your ability to take risk, which is based on the 2 points I just made in terms of funded status, your assets versus your liabilities, but also your stomach for risk, but taking a more realistic look at that. Today, if you take a typical risk tolerance questionnaire in a rising market environment, most investors will come out as being as aggressive. Everyone wants to be aggressive when the market's doing well. Mm-hmm. But I think investors need to kind of think outside the box a little bit and try and quantify in their minds what's the worst case scenario. At what point would I really feel like I'd be running for the hills and pulling money out of my portfolio, because that is more devastating, going to cash and being in cash for long periods of time and missing out on growth, then sometimes the market drops themselves.
So ability to take risk versus willingness to take risk.
Absolutely.
And there is a difference.
And that willingness issue, how do you really find out what people think? Because a lot of people come in and see and say, yeah, I'm willing to take risk, and then after a year later in 2009, after a 50% drop, turns out they weren't. So how do you make sure that they really understand the question?
Fantastic point. I think you've got to show them the numbers.
Yeah.
I think you've got to take the time to put it on paper to them and say, okay, we know what your asset base is going to be at retirement. Let's shave 30% off of that. How does that impact your long-term ability to fund your retirement? Yeah. And the numbers are going to, put things into perspective a lot differently than saying, do you want more money in stocks or more money in bonds today?
Your firm works primarily with corporate executives. How do those executives' portfolio needs and their level of managing risk differ from, let's say, a non-executive?
The biggest driver there is single stock concentration, and that's at the executive level, and that gets down into any employee of the company who's given shares. A lot of times, those that are holding company stock will say, okay, here's my bucket of my, let's say, Coca-Cola shares, and then here is my investment portfolio. It's very important to look at those two together and say, what's the risk that I'm facing in my company shares? A realistic look at what the risk is. What sector exposure do I have? What size exposure? Is it a large cap company or a small cap company? And how is that volatility, how is that risk composition going to work with the rest of my holdings? And how can I position my satellite portfolio to balance well around my company shares?
Thank you.
All right, Chuck, I know that you had a few questions you wanted to ask me, and maybe Adam can pipe in with his opinion on those also.
Absolutely. I'll direct them primarily to you. So obviously, folks that are tracking interest rates are watching very closely short-term versus long-term interest rates and the yields. There's a risk, I guess, of chasing yields. Could you comment on that?
Sure. I think people have to understand that until 2008, the Federal Reserve only controlled short-term interest rates, and market forces controlled the long-term rates. Back in the late 70s, the Federal Reserve pumping money into the economy, they were reckless, allowing inflation to come back, and so the bond vigilantes, the long-term bondholders, could drive interest rates way up. Well, what we have to realize now is we're in an environment where the Federal Reserve has been attempting to control short-term and long-term interest rates. And they're trying to get out of that mode and go back to just controlling the short-term rates. And it's going to be a difficult transition. And people have been forced out of their money market funds because rates were so low. And now they say, 10 years ago I used to be able to get 7% on a government bond. Now I can only get 2.5%, 3 3/4, depending how far out they're going. Where can I get my 7%? Well, some people decided to go after energy a few months ago. And all of a sudden, that sector got cut in half suddenly, depending on what particular part of the energy sector. So I just caution people that when something's paying 9% in an environment where a government bond is paying 2 3/4 or 3 3/4 when you go way out there, you have to be careful about Will Rogers' theory. I'm more interested in return of my investment than the return on my investment sometimes.
Good point. And you're obviously expert on tracking, the dollar, and talk a little bit about hedging, because I know that's something that we've talked about.
Well, one thing I've learned in the 45 years I've been an investor and 25 years I've been doing this is that it's very hard to be an expert on currencies. But I do watch it, and I do worry about it a lot, and I try to do what I can to sort of protect my clients and myself against it. So, for example, now we've had a huge rally in the dollar, and I'm not trying to time the show here, but over the last few months there's been a large rally in the dollar, and now you're starting to hear a lot of people come out saying you should be hedging your risk. Well, it may be too late for that. We may see that the euro and the yen will stabilize somewhat at this point. We don't really know. But what you can do about that is to be aware of the fact that if a currency is going to rise, it's going to have a positive effect in overseas markets for corporations that want to ship to your currency, and it's going to have a negative effect for conglomerate type of companies that do a lot of their selling overseas. So you have to take that into account. So if you notice that a certain stock in the United States, let's say a chocolate company, is selling at 22 times earnings, and a very good chocolate company over in Europe is selling at 14 times earnings, you want to be careful about buying that U.S. stock at a time of a rising currency. Now, another way you can hedge is to own some overseas stocks and own some U.S. stocks, and then you get a natural hedge.
So we're talking obviously about investment management, and the debate really rages on with regards to active versus passive. Active management versus things like exchange-traded funds. Do you want to just comment?
Well, sure. There are managers that can do a really good job of studying the markets and have long-term track records of outperforming, and then for periods of time they will underperform, and you have to be careful about not chasing the latest winner. So, for example, a year ago, ETFs, buying an index, was getting a better performance. Of course, when you buy an index, you're getting 99.8% of the return of that particular market because they do charge a small expense ratio. And you're hoping, if you invest with a manager, to outperform that market, and those tendencies will change. Some managers say, I will use exchange-traded funds in utilities or types of things they're not good at selecting the winner in, and then buying the technology stocks that they think will outperform, and some of them are pretty good at doing that. And some people just want to invest in ETFs and accept the fact that they're going to get 99 point something or other percent of the return if the ETF is designed properly. And they may be disappointed. I've seen a lot of ETFs where people find that they aren't keeping up for various reasons, and it's not worth getting into the details of that at this show.
So, there's a lot of moving parts to the investment world. We've talked about the dollar. We've talked about interest rate yields. Talk about commodities.
Well, I think of commodities as one of the vigilantes. I like to look at the three vigilantes that keep us honest about inflation. We had the horrible inflation in the late 70s, and how did we recognize we had the problem? We had commodity prices going crazy. Gold went from $300 to $850 adjusted for inflation, higher than it is today. We had long-term government bonds shooting up. Mortgages were 16% in some cases. 30-year U.S. government bonds were 16%. And the dollar was dropping like a stone against foreign currencies. And those are the three vigilantes I watch. So right now, as I'm looking at things, I say, looks like inflation's not a problem, but commodities are one of the things I'm counting on to warn me as an early warning, the canary in the coal mine about inflation. And 30-year bonds are behaved well right now, but if they were to start going through 5% and heading towards 6%, I'd start to worry. And if the dollar reversed and started coming down, I'd actually like to see the dollar go into a trading range. But the dollar starting to fall out of bed would be a sign that inflation's coming back in the U.S.
So there's obviously different ways to manage for long and short, and there are funds that are available. Do you want to just take a brief moment and comment?
Sure. In 1 minute, I'll just say that hedge funds can advertise that they know how to go long the good stocks and short the bad stocks. Some of them want to charge 20% of anything they make and charge you 2%. There are very, very, very few managers that are worth that. So there are different ways that people can invest their money. They have to take into account somebody that's really good maybe deserves to be paid a little more than somebody that's not so good. But when the costs are exorbitant, I would not be chasing that person, because I don't think it's fair for people to be charging that much, because they don't give you anything back in the year that the market goes down. They keep their 20% in the year that the market goes up. And a lot of hedge funds are chasing their prices.
Yeah, fees can kill you.
Sure. Okay, well, next week we're going to have William J. Watkinson, CEO of Watkinson Capital Advisors, and this is going to be some bond advice. And I think bond advice is a good thing to get right now, because it's tough out there in bond land. So we hope you'll join us next week. As far as we're concerned, your money matters.